Welcome to Barchart's series of educational webinars. Today's session, the art of multiple time frame analysis. Just as a commercial fisherman checks the tidal charts to determine the optimum time to leave the harbor or to cast his nets, market technicians consult the charts over multiple time frames to obtain a better picture of where price of markets has been, the path of least resistance it could go, its current direction, and locating levels of support and resistance to help determine risk as well as set targets and reward. Hello, everyone. My name is John Rowland, Barchart's senior market strategist, and the multiple time frame analysis methodology is a time-tested process that drills down from a higher time frame, which defines our range of price and the probability of movement, to an intermediate time frame where we're going to find actionable trends through lower time frames that are used for choosing optimum entries and exits with our primary and intermediate trends, and in addition helping us to reduce risk and increase our rewards. Now, regardless if you are a day trader, a swing trader, or a long-term investor, multiple time frame analysis give you a better perspective on price movements, trend analysis, and risk management. So stick around as I reveal the technique of multiple time frame analysis. And so usually to help me, I have Barchart's project director, Gene Baker, with me, but Gene's away this week. So I've asked my Market and Close co-host, Thomas, to step in. Hello, Thomas.
Hello, John. How's it going?
Good, going well. Thank you for stepping in and helping me out this week, and hope that you will get something out of today's session. So
Yeah,
listen, Tom, go ahead, Thomas, I'm sorry. So Thomas's depth of knowledge of all things Barchart might not be at the level that Gene is. So be a little patient with him. But I will remind you that if we don't get to your questions today or Thomas is unable to assist you, you can always send your questions to support@barchart.com. And, they can also send those through to me. So, Thomas, you ready to get started?
I am ready and excited to hear what you've got for us today, John.
Okay, Thomas, thank you. All right, so remember, today's session is for educational purpose only, and decisions to buy, sell, and hold, or trade securities, commodities, or any other investments involves risk, and are best made on the advice of a qualified financial professional. And under no circumstances shall we be liable for any loss or damages you or anyone incurs as a result of trading or investment activity that you or anyone else engages on based on the information or material you receive through Barchart.com and our services. Okay, so what is multiple time frame methodology, right? What does this mean, right? Well, it's a process of drilling down from a higher time frame to lower time frames. And each time frame is going to have a purpose depending on the style of a trader. Now, your style might be a trader or investor. So choosing a higher time frame that gives you a big picture perspective. Now, be it monthly or weekly for, let's say, investors or swing traders, to, let's say, a day trader who might use daily or multiple hourly time frames. Now, the purpose of the higher time frame is to identify this playing field of probability. In other words, where has price been? Where can it go? What is the path of least resistance? And where is price at risk? And really the main purpose for a higher time frame is just to identify a primary trend. And this, for determining our purpose, we're going to take today is I'm going to look at from a perspective of a swing trader, right? So I'm going to look at that tact. And so I'm going to choose weekly as my higher time frame. Now we're going to drop down to an intermediate time frame. And we're going to call this our trend trading time frame or our actionable trend. And the purpose here is we're going to try to capture a piece of that probability that we discovered in our higher time frame. And hopefully our goal is discovering trades that are with our primary trend. Now we're going to locate our swing highs and swing lows, and this is going to help us define risk to our trend, but also help us determine where price falls inside of that range. And then we're going to move to a lower time frame, and the lower time frame's purpose is really to help us define the type of trade that we're going to initiate. Are we going to look for drawbacks or pullbacks, or are we going to look for breakouts? But it's also going to help us to use better timing for our entries and our exits and help us manage risk. Now, many times we're going to discover that trade opportunities where the lower time frame price action, let me say it again, that the lower time frame price action is opposite of our primary or our trading trends. But ultimately, we're going to take trade signals in lower time frames that are with our higher time frame trends. And that's the concept of multiple time frame analysis. All right, so let's start with the higher time frame. So what is the purpose of the higher time frame? Well, we said that our purpose is to identify our primary trend and then look at current price and see where the direction of price is going. Where is that location inside of our range? And where is that path of least resistance? This is going to be our probability. We're going to look for where we think price has a greater probability of moving towards, and where does it feel like there might be resistance or support. Now, there are many studies that we can look at to help us, but remember, our purpose here is to help us identify that trend, and that could be in terms of strength or momentum, or again, in that vulnerability of our trend, our risk to our trend. So there are some ones that I think that are kind of standard we can use. And so, you know, a 200-day moving average in terms of equities is a really popular long-term primary trend moving average. Now, I said to you that I'm going to use a weekly chart to do my higher time frame analysis. So if I use a 20-period moving average on a weekly chart, I'll be looking at a 20 weeks moving average. I don't want to do that, right? So what I'm going to do is I'm going to look at a 40-week moving average on a weekly chart. Now that in essence is a 20-day moving average, right? 5 days a week, 40 weeks, that's 200 days, roughly. I mean, you give or take a few days. So a 40-week moving average would be a good weekly time frame to look at. We're going to look at ADX. Now, ADX is a great tool for confirmation and strength of trend. Now, I'm going to give you an example. We're going to go walk through one example of ADX, but in a past session back in January, I think it was the second or third week in January, we did a webinar on multiple time frame analysis, and we go into a lot more detail about how to use ADX in terms of multiple time frame analysis. So I'm going to walk through one example today, but if you want a greater understanding of ADX and how to use it, I would refer you to that one. Today's session is really more about probability. We're going to look at that where we believe prices are going to move and where is the probability of price moving in certain directions. ADX is going to really just going to confirm and tell us the strength of our trend. We're going to concentrate on some other studies this week. MACD. MACD is a great tool in terms of trend momentum, and there are other tools we can use for momentum oscillators. I'm sure you're familiar with stochastics and RSIs. But a MACD in a higher time frame is going to give us this trend momentum. Now, it might give us a buy or sell signal. MACDs can do that, but we don't really care about that, right? We're not concerned about the signal. We're really just going to look at the momentum of our trend. And then we're going to move to something called Bollinger Bands. Now, Bollinger Bands are measurements of volatility, and they're based on something called standard deviation. And there's a probability of price that says that a two standard deviation, that 95% approximately, 95% of all price action occurs inside of two standard deviations. So Bollinger Bands are going to help us define a range of probability, and also we can look at volatility. But I'm going to show you a technique that I use, which we're going to use. It's called zones of actions. And what we're going to do is we're going to draw lines on the outer bands of our Bollinger Bands, and when the market reaches those levels, those are going to be levels of zones of actions. Now, I don't know what trade I'm going to take. It's going to depend on the conditions and the circumstances when price reaches there, where I am in my range and what my trend is doing. But the technique of identifying where I'm going to be patient and wait for price to reach one of these zones of action. Okay, so let's do this. Let's see, where am I at? Okay, here we go. So I'm going to go to Amazon here, and first thing I'm going to do is I'm going to pop this chart out. It's just going to make this a lot easier for me to do a lot of this demonstration. I don't want to like condense it on a small chart. So let's just do this, eyeball this. Let's do this multiple time frame analysis. Let's start here and let's just eyeball this, right? I'm not going to use any technical tools here. I'm just going to look at this. And what do I see going from left to right? Well, from left to right, I see a market that started over here and is finishing over here. So what is it doing? Well, it's moving down. So what does that kind of tell me? Well, that's kind of telling me the market is in a downtrend, right? Now, if we think about a downtrend, right? What is a downtrend? How do we define a downtrend? Well, a downtrend is a series of lower highs and lower lows. And is the market exhibiting that? Yeah, it certainly is. Now, we could make an argument here that, you know, this downtrend, this exaggerated downtrend, that price has recently broken that would be a fair assessment. But what have we seen here, right? We have gotten a rally of recent, especially since the beginning of January. But have we made, in this higher time frame, have we made a new high? No, we haven't, right? So at best case, we might say that we're in a sideways trend, right? Or that we're maybe transitioning from a downtrend to an uptrend. But what do we need for an uptrend? Well, we need a series of higher lows. Well, we've got a couple little higher lows, but we still have yet to make a higher high in this time trend. So what we see is we see a downtrending market that has probably shifted towards more of a sideways action. So what did we say? Well, we could go into our studies and start with one of those moving averages. Now you can type in the study that you're looking for, but you know, I kind of go really quickly through here. It's so easy for me. I'm just going to moving average. And remember, we're in a weekly chart, so we're going to look at a 40-week moving average. And what do we see? Well, again, kind of confirming what we already eyeballed in our process, that we were in this downtrend. Price is now broken above our 40-week moving average as starting to turn, right? But now price is, you know, kind of moving back towards our 40-week moving average. Now, what we can do here is now is, well, let's define our range based on highs and lows. And so I'm looking at a 3-year time frame here. So I'm going to come in here and I'm going to draw a horizontal line. And notice this little half moon right there. See that right up there? That represents the highest price in this data field. Now, it's really easy for us to eyeball this. I can tell you where the highest price by just looking at it. But what we're going to do is we're going to do this process because we're going to reference these highs. Because as we change our time frames, our reference is going to change, but these lines will not. So here's our most recent high and our most recent low over the last 3 years. But let's look at what's happened from this point, right? This most recent high as opposed to this recent high. Let's go back and let's make our chart a little bit bigger. Now notice I've changed my reference, and now our low is still the same, but our high is a lot lower, so we can now define. So where are we at? Well, let's go back and we look at this bigger picture. So we look at this bigger picture, where are we at? Well, we're kind of right in the middle of the range over the last 3. So what does that tell us? Well, maybe the market is sideways. That's what we're kind of getting from this analysis. Now, if I go and look at those 2 highs, and I do that analysis, well, where are we in this picture? Well, we're at the high end of this range. So what does that tell me? Well, it means that if I believe the market is in a bullish scenario, maybe I might want to be patient and wait for a better buying opportunity where prices are a little bit cheaper. You know, think about in terms of support and resistance. There's kind of some wood that needs to be chopped for me to get higher here. If I'm bearish on the market, or my time frame analysis is telling me that there is more likely that price is going to move lower, then this will give me inclination of being more looking for selling opportunities. So where is the path of least resistance? Think about that now. So the path of least resistance, certainly there's some resistance just above us, but below us, we've determined that there is some technical support right at our 40-day moving average. So what I can do is I could draw another line, but a real quick trick that I can do is I right-click on any of the lines I've already previously created, and I can clone that line, and then I'm just going to drag it up here. So now, in this higher time frame, what have I done? Here's my range of probability that I'm thinking about. I'm probably thinking about looking for selling opportunities a little bit higher, or I'm looking for a buying opportunity near that 40-week moving average on this line here. All right, so what was some of the other things we could go? Well, we could go to our ADX, average directional index. And here's the default 14. You can change these as you want. So I just leave it at the default. What I do is I do change the defaults and the colors of the lines. It just makes it easier for me. When we talk about ADX, there's 3 components. There is the DI lines and there's the ADX line. So a negative DI line represents when the market is selling or when there is selling pressure, and a positive is a buying. So let me kind of boil this down for you. So these 3 components, right? The positive DI and the negative DI. So they represent a proportion of the current period that is outside the previous period. So in other words, if we're in an up day or up week, we're going to get a positive DI. If we're in a down, we're going to get a negative DI. And this kind of helps us determine who's winning that battle between buyers and sellers. And then the ADX line is an exponential moving average of the absolute value of the difference between the 2 DI lines. So what could happen is, oops, I forgot to add it. What could happen is you could see a rising DAX line in a falling market, right? Because there is more sellers, more selling pressure than there is buying pressure. So the ADX line is really an absolute value. So what do we see here? Well, what we see is that our ADX line is rising. That is a sign of a trend. And our green is above our red. So that's a sign of an uptrend. So what we are seeing at this higher time frame is, yes, we are seeing an uptrend, and we've kind of confirmed that. So I'd still want to be a buyer, but I might want to be a buyer at a lower level. Now, what is happening to our ADX lines and our DI lines? Well, they are changing directions, and they're coming closer together. So this is kind of telling us the strength of this trend, or the momentum of this trend, is waning. So let's go to MACD. And again, there are regular MACDs and we have exponential. Again, it's up to the trader. I kind of prefer the exponential. Again, I'm not going to change any defaults here. And again, we're not looking at this as in terms of a buy or sell signal, and common interpretation, right, here would be crossovers. That would be a buy signal. We're more concerned about the strength or the momentum of our trend. And if my MACD line is above the 0 line, that's right here in the middle, that is a confirmation of an uptrend. If it's below, it's usually a confirmation of a downtrend. So you can see right about here is where we got above the 0 line. Notice how it correlates where we broke above the 40-week moving average, where price got above that, right? Another confirming sign of an uptrend. And our signal line here got above the 0 line, right, about here as well. So that would be another confirming sign of an uptrend. Now let's just go back to the ADX line here for a second. So Wells Wilder did say in his analysis of the ADX line is he likes to see the DX above 25 to confirm a positive momentum or a positive trend. So you can kind of see here, let me go here, you can see right about here is where the DX line, or the DI line gets above 25. And again, that correlates right with the same level we saw with our MACD. But Wilder also went on to say that to confirm a trend in the ADX, you need to see the ADX line above 20. And again, notice where that happens. So what we're seeing here now is a confluence of technical evidence from these two indicators that lines up with our moving average. So this would be a great area for us to start thinking about buying into Amazon if price got down there. Again, I'm using patience. I'm not going to make that decision until price gets down there, but it certainly is telling me I shouldn't be buying right now. Now, in terms of a risk to the downside, is any of these technical analysis giving me permission to take a short in this higher time frame? Not really, right? Not really. Okay. And so the next one that we said we could use is our Bollinger Bands. And so let me go back to our Bollinger Bands. And again, the default is 20 periods, and the width or the standard deviation is 2. And again, the theory behind that is that 95% of all price probability is going to be inside of 2 standard deviations. And again, I have reconfigured my outer bands to different colors. Again, my mean is going to be my black line, and my outer bands are going to be my red line. So I'm going to add that. And what we're going to do is we're going to draw lines on these outer bands. And this is where we're going to look for that probability, or those zones of action where I might start thinking about taking a trade. Now, again, I don't know what the trade I'm going to take. I just know that when price gets there, there's something's going to happen, right? There's going to be an increase in volatility, or we're going to be some kind of a mean reversion. Now, I think it's kind of fascinating, and this is why I used Amazon as an example in our process today, is that notice how I already drew these lines based on other analysis. We just looked at these lines based on our swing highs and our swing lows, right? We were just kind of eyeballing it. And then we found this black line here based on, our technical analysis and how they line up together. And this is that confluence of technical analysis. So I'm not really going to draw any new lines here. I'm going to stay with the ones that I have. What I do see here on the Bollinger Band, though, is that price is now below an upsloping moving average. That is kind of a bearish sign, but it doesn't mean that our trend is going to change. It just means that there's a higher probability now that price is going to fall to the lower band, which might be that opportunity for us to look for a buying opportunity in Amazon when we get there. So drawing these lines at the outer bands is a great way to kind of define a range of probability. All right, so let's do this. So let's go to our intermediate time frame. Well, our intermediate time frame is our trend trading time frame. This is where we're really going to make those decisions in terms of if I'm going to go long or short. And again, our purpose here is to identify price action and look at our trend in terms of our strength and momentum. And again, there's a lot of different studies we can use. You might have a favorite one. And again, I'm going to make some suggestions. Those are not in stone, but we talked about the ADX, that we can look at the DI lines as above 25 is a trend has been established, and below 20 is a kind of an indication of a sideways market. Bollinger Bands, again, we're going to go down to this intermediate time frame, and we're going to look at those outer bands as areas where we can start thinking about potential trading opportunities, but also this volatility. Are my bands widening or narrowing? Is volatility coming into the market, or is it coming out of the market? ATR, which stands for average true range. We're going to go into a little bit more depth in this in a couple of examples later in today's session. But again, in our archives under our learning section in our web page, if you search Swiss Army knife, you will see that I have what I think is a very detailed webinar on average true range, which I call the Swiss Army knife of technical indicators, and it tells all the different ways that you can use ATR. So we're going to look at a couple examples as we go through our process today. Again, this is more of a probability tool. That's why I like it for multiple time frame analysis. MACDs, now we're in our intermediate time frame. Our MACD here is going to serve two purposes for us. Again, it's going to help us determine the momentum of our trend, but this is where we can start looking at those buy and sell signals that are traditionally the concepts behind MACDs. We can look at different moving averages. Again, if I'm an investment trader and I'm looking, let's say, monthly as my higher time frame, and I'm using weeklies as my trend analysis, maybe I'm going to use that 13-week EMA, exponential moving average. If we think about 13 weeks on a weekly chart, what does that represent? Well, that represents about 3 months or a quarter. So what you're really looking at here is a quarterly moving average. Now, if I'm using daily as my trend trading time frame, maybe I'll use a 9-day. That kind of represents 2 weeks of trends. You might use something a little bit lower than that. I know some folks that use 3 and 4 days EMAs to help them define trend on a weekly basis. RSIs, right? If you're familiar with RSIs, these kind of give us our oversold and overbought conditions. And again, we could look at stochastics in that frame as well. But what we really kind of want to do with stochastics is we want to look for those contra-trend signals. In other words, in this intermediate time frame, I want to find oversold conditions in an uptrend, or I want to find overbought conditions in a downtrend. to look for those entries that are in concert with our higher time frame analysis and our higher time frame trend analysis. So this contra price action, but the signal we want to take is with our higher time frame trends. All right, so let's go back to Amazon. And so let's drop down from a weekly. I'm going to go to a 6-month daily. And I still have my Bollinger Bands up, so we can start there. And you know, it's kind of interesting is today is we can see that our weekly Bollinger Band, outer Bollinger Band, lines up with our daily. So this is now kind of telling us that there's some significance to this level, right? Now, if price shot up there instantly, maybe that'd be a great selling opportunity. But it's certainly kind of telling us that there's a lot of selling pressure above the market. Now, what do we see here? Well, we can see that our bands are starting to widen. That's telling us volatility is coming into the market. But what I can do is, again, I can just go right click on any line. Whoops. Right click on a line here, and I'm going to clone it. And so I'm going to set my line on my outer band. Now, what is that telling me? Well, it's telling me that today there is an actionable opportunity in Amazon. Now, I don't know what that might be, but let's think about our trend analysis at our higher time. We said sideways to lower. This might be an opportunity to get in a short. Or what is telling us here is that there might be a buying opportunity if we've come into a level of support. Again, where is the market at risk? Where is the path of least resistance? So let's do this. Let's take away the Bollinger Band so we can see this a little bit clearer. Well, we are right on a level of major support. Matter of fact, we could make an argument we're probably close to being below that. So where is the market at risk, right? Is the market at risk of rallying from here? Or is the market at risk of falling to that level that we've already discovered at our higher time frame? And I think if I took a survey here, we'd all say that it looks like there's more risk to the downside than there is to the upside. What are our ADX doing? Well, you know, we have a very strong DI line, right? But our ADX line has not confirmed that trend. Did we get a crossover signal already? Yeah, we did in our MACD, and our momentum is very strong. So really what we're seeing here is these two indicators. One is kind of saying, yeah, there's downward pressure. This one has already told us that there was an opportunity to sell this particular stock. Now, let's go to one of our moving averages. So I'm going to go back in here into our moving average studies, and I'm going to go to our exponentials. And one more, there it is, exponential. And here's a 9. So let's see what that looks like. And again, this is our trend trading time frame. And what is our 9-day moving average is telling us? Well, pretty obvious here, isn't it, right? We have broken down. We are accelerating. Our trend is down, right? So a confirmation of I want to be more inclined to looking for selling opportunities than I do looking for buying opportunities. Now, at this moment in time. Now that might change when we get down to this level, but for today, that's what the market is showing us. Now, in terms of ATR, or average true range, what we can do now is you start using this in terms of where do I think price is going to move today or over the next few days, in terms of helping me determine risk or probability. And so one of the ways we can go and find that ATR is I can right click on my chart, and here it says more data. Now, if you're just on a regular interactive chart, you can go under the technical analysis page. But you can see that the ATR for the 20-day is $3.62. So that is not a directional indication. It's just telling us that at a range of prices about $3.62. So if we look at what Amazon is doing today, well, it's down about 81 cents. Now the range, 127.50 on the upside and 123 on the downs. Well, it's at 124 on the upside. We're kind of, a little bit more room for us to run, which is telling me that there still could be more downside here. Or I can use this as a risk, saying if I take this trade today, what's my risk to the upside? Well, I could set it based on one ATR. So in other words, if I'm going to take a short based on the fact that we're below this black line, my risk in this case would be for today would be that ATR or that value that we just saw. So that could help me determine that risk. If that risk, as I said, was, I think it was $2.50, $3.62. Well, now what I want to start thinking about is, do I want to take this short trade based on the room that I think that the price could fall? So if I take an entry right here around 125 and I'm going to risk $3.62, right? I want to make sure I get enough reward. So how much reward is there potentially in here? Well, it looks like about $10 or about $11. So that would be on the borderline of a trade that I'd be willing to take. And we'll look at the risk reward ratios in a moment. But that's a way we can kind of use it. Now, if that risk is too much for us, well, then what can we do? Well, we can go to a lower time frame, right? And the lower time frames are going to be our intraday time frames, regardless of the style of trader that I am. And we're going to use this to help determine our entries and exits. And remember, we want to take trades that are with our primary and intermediate trends. Again, we've already discovered that we're looking at a downtrending market. And our purpose here is to help us to reduce our risk, but also to help us to increase our reward. So what are some of the tools? We can use our RSIs and our MACDs, our buy and sell signals. Now, remember, we want to take buy and sell signals that are with our higher time frame trends. In this case, we want to look for sell signals. We can go in equities. This is a kind of a cool little trader's insight for you. So if I'm now at a lower time frame and I'm in one of these intraday time frames and I'm trading equities, and we think about the time of day that equities trades, 6.5 hours. Well, if I use a 13 EMA and I use a 30-minute period, well, there's 13 30-minute periods in a 6.5 hour day of the equities markets. So what we're going to create is a moving average that represents the trend for the day, which is kind of cool, right? And what we will discover as I show this to you is it has the same effect like we did with the Bollinger Bands, these zones of actions, when price re-engages this 13 EMA. Now, these zones of actions could be opportunities for entries, but it also can help me in terms of risk management, in terms of exits. ATR, again, if I'm a day trader and I'm not using daily ATRs, maybe I'm using 2 hour or 4 hours, my trend time frame, I can use this as a way of doing price probability and also help me with my targeting. Now, again, an example of Amazon, the ATR range is $3.60. Well, I might look for an entry that is somewhat less than that in terms of risk, or as I'm looking for targets, right? Those opposing zones or those opposing areas where I think price might slow down, those might be multiples of my ATR. And I'm going to be kind of conservative, not that I will exit a trade, but I'm going to just use those conservative values in terms of ATRs to help me assess a trade. Floor trader pivots are a great intraday tool. Again, these are going to help us with our support and resistance levels and our risk management. And another one that we can use is called the VWAP, and this is the volume weighted average price. Now, again, in our library of archived webinars, I've done one on this one as well, and I go in a lot of detail about how to use it. For time's sake today, we're not going to get into this, but again, we can use this as a momentum indicator as well as a risk management tool. Let's go back to Amazon, and now I'm going to go down to our lower time frame. Again, I know default here, you can see a 5-day is going to give me a 30-minute intraday, and we know that we don't need our ADX anymore. Now we could use our MACD. Let's just kind of look at what the MACD is doing, right? And the MACD, the momentum has been down, but we're really getting close to not a sell signal, but actually maybe a crossover of a buy signal. So we're getting a little confluence here, a cross current here in terms of the MACD. But the other thing we said we could do is look at a moving average. Now, this moving average is a simple moving average, so what I want to do is go into studies and look for an exponential moving average. And I can do that. But one of the nice things about Barchart is we can create templates that have our studies already created for us so that we can quickly add them back into our charts. So here I have a 13 EMA, and that is going to give me a 13 EMA trend line, moving average trend line. And also you can see I've added in this template our floor trader pivots, and here's our RSI. So again, in terms of risk management here, or in terms of our market analysis, right, on this particular given day, there would have been an opportunity, you can see, of our 13 EMA. If I look at over time, you can see how this really kind of is a really nice little tool for equities, how it can be used as a level of support and resistance, but also, in terms of when you get significant price movement above or below, also it can be used as risk management. So for today, what I noticed was coming into today, right? Here we have our pivot that is right in line with our 13 EMA. That might have been a great entry for a day trader or even for a swing trader today based on our trend analysis that we wanted to look for selling opportunities. Now, in terms of our ATR, we said it was about $3.60. Right. Well, as a day trader, if I got this trade, well, I need to find a target that's going to be inside of $3.60, which would put us around, 124. And, where was the low for today? Well, so far the low today was right around 124. So if I was a day trader, I certainly would want to be out of this trade. But in terms of risk here, as a swing trader, I might be saying, okay, I'm going to take a short based on the fact that we're below the 13 EMA. We're now below this line of action that I've already created in the higher time frame. And what might be my risk? Well, my risk here might be I'm going to risk the pivot, and that risk looks like it's about $2. Which is less than my ATR. That would be a manageable risk, right? For us, a low risk trade based on a probability of where we think price could go. Well, I risk $2. It looks like it make about $10 or 5 to 1. But I think that also what we have to also consider when we take into these floor trader pivots is that there are lines of support, and these are also roadblocks or speed bumps that we have to be aware of when we do this risk assessment. Now, what I think is kind of interesting here is if we look at where these support lines line up today. Now remember, our floor trader pivot is based on yesterday's price action. And here we can see that both of these support lines are on structure that was created back in June. So again, I don't know if this would be a great shorting opportunity because I got a lot of wood I got to chop, but certainly the risk reward ratio at the higher time frame makes this trade doable. All right, Thomas, let's do this. Let's take a quick little break here. I know there's probably some questions that folks are in. Is there any questions that are kind of consistent or not?
I sent you a few there, John. So one question here is, are floor trader pivots basically resistance and support levels?
They can be both resistance and support. So in terms of momentum, the first time you get to a level, a resistance or support level, floor traded level, that would be market would respect or should respect that. But let's say market opens above a resistance level. Well, then when price returns to that, that actually could be now become a new support level. Certainly the pivot is a way we can look at that. So in other words, if we go down to a support level, find a floor trader support level, and then we get above the pivot, and then we get to the first resistance level, when the market retraces or pulls back or draws back, then the pivot will now become support. At the first time up, it might have been resistance, depending on how price action moves. So first time would be true to what the value is. Second time might be the opposite. Okay.
We also got a question, John, on zones of action. If you could provide some clarification on what exactly that means.
Okay, so we'll do that. We're going to look at a couple examples as I move forward. I'm running low on time, but I want to give you at least one more example. So let's talk about some studies and tools that we can use. And let's kind of just go over what we just talked about. ADX, right? We're going to use that for our strength of our trend. ATR is that volatility measure, how far I think price can move in one day, that true range of price probability, and this is going to help me with our risk management. Bollinger Bands, again, that's that question about our zones of action. Our 9 and 13-day EMAs, these are great intraday, but also in intermediate time frame. Again, we're kind of looking at the strength of our trend, the direction of our trend. Now, again, for equities traders, for swing traders, there are a couple of moving averages that I didn't discuss that I think can be used. The 20-day moving average is a great one, I think, for looking for entries and exits. These are the ones we're going to look at the intermediate time frame. Again, I'm looking at a daily, intermittent time frame. A 50-day moving average is kind of where I might put my hard stop, right? Nothing really happens good when an uptrending market starts closing below the 50-day moving average. It's usually a good sign that you probably want to be out of that one. And then, that longer term perspective, that 200-day, or if we're in a weekly chart, that 40-week. Our MACDs, again, are about looking for buy and sell signals in our lower and our intermediate time frames. But in our higher time frames, we're only going to use MACDs to look at momentum and strength. Our RSIs and even our stochastics, we can use them for overbought and oversold conditions in all time frames. Again, what I said to you is I kind of use the stochastics in those lower time frames, but I will look at RSIs in all time frames. And then those floor pivots and VWAPs as our intraday breakout entries or our price reversions, our risk managements, our support and resistance. Okay, so let's go back. And the question was zones of action. So here's ConocoPhillips, and so I've blown this out a bit so you can see it. Now, the process I just did with you with Amazon, we started on one chart, then we went to another chart, and then we went to another chart. Now, what Barchart does for us is we have something here it's called the grid. And if I click on the grid here, and I open that up, notice that I have a couple different ways I can look. I can look at two boxes side by side, or two boxes on top of each other, or four boxes. And I kind of like the four boxes. And what this allows me to do is, for this particular equity or whatever market I'm looking at, is allows me to design a multiple time frame analysis. So you can see here, I have a 5-day, 30-minute. I have a 10-day, excuse me, a daily 1 year and a daily 6 month. And then I also have a weekly. Now this one, actually, this one has been a little bit messed up. Let's do something here. Let's go to my dashboard. I think I already set this up. Let me just check out something here. So I can do this through dashboard as well. Yeah, okay, let me do this. All right, so this is fine. Actually, let's go back here. Yeah, this is kind of strange. Let me just hang on a second, folks. Let's do Microsoft then. All right, something is weird just happened. Okay. Okay. All right, so one of the things we can start to do now is in the grid is actually, why is this not popping out for me? Hang on, let me turn this off a second. Okay, there we go. Is I can start adding different studies. And what we can do is we can add up to 3 studies. So what I'm going to do is I'm going to add some of the same studies that I used before. For instance, I'm going to use Bollinger Bands. I'm going to look at a moving average. And an exponential, and the one that we said that we can kind of use in multiple time frames is our 13, right? And then I'm going to add a standalone, and the standalone study that I'm going to look at is our MACD. And what's nice about this here is I can look at a wide range of time frames. So let's kind of do this. Let's change this one to a 6 month, and let's make this one more like 2 years. And again, the daily here are both the same. The data is going to be the same. It's just giving me a little bit different perspective. But what I can do now is I can look at all these technical analysis that I like, and also start doing that process of looking at what my trends are doing, what is the risk and what is the probability. So for instance, in here in Microsoft, right, let's start at our higher time frame. What do we see? Well, we kind of see that we're in a range where we're at an area on our Bollinger Bands, a zone of action. Now, I don't know what the trend is going to do or what the trade is going to be, but what I do see is that price is now below my 13-week moving average. I'm down and low in the range of probability. What is my trend time frame, my daily trend time frame? Again, we're at this zone of action, right? We're at the lower end of our Bollinger Bands, and our trend, right? Our trend price action is below. So to confirming actions, what is happening in our intraday? Well, our intraday, we can see our trend is lower, right? Now, I'm not really worried about Bollinger Bands on intradays, but I will take that into consideration. What is my momentum? Well, in my higher time frame, my momentum has changed. The momentum is now trading lower. My momentum and signal is giving me permission to look for a short. And what is happening to my momentum in my lower time frame? Well, it's still below the zero line, and we'll maybe wait for that crossover that would give us that sell signal. So I've done the multiple time frame analysis, which gives me permission to take a short, and that's kind of what I wanted to do here, is go back to our turn our grid off, and now I'm going to go to that lower time frame. I'm going to use that EMA, and so the first thing I'm going to do is I'm at one of those levels of decision or action. I'm going to look at my more data, and for Microsoft, looks like the 20-day ATR is $6.15. So I'm going to start looking for trades where I'm taking less risk than $6.15, but also where can I find that potential price movement. Now, I kind of took the liberty this morning of setting these up based on where our Bollinger Bands were, and so you can see we're below a level of price action in a daily Bollinger Bands. And this lower one is our weekly. So let me just put that back in there so you can see that. There is our Bollinger Band there on our daily, and there is our weekly. So we're both at the same level, and this would be a target that I was looking for. So now I'm going to go back to my lower time frame, and let's get rid of our Bollinger Bands and get rid of the noise. What's our risk? Well, we're willing to take up to 6, but maybe something less than. Well, I could certainly, now that we're below here, I could risk today's pivot or this 13 EMA, which is around $311. The pivot is around 312.96, right? If I took a short right here around 310, what that risk? Well, in this case, it would be about 2.5 or half of my ATR, less than half of my ATR. And my reward, my potential reward, that's zone that I'm looking for, right, would be around, $20. So I'm risking about $2.50 to make $20. I think everybody in this room would take that trade. Could I use this as an opportunity to buy? Well, yeah, maybe I could. Maybe I'm at that zone of action where I'm on the lower end of my Bollinger Bands. But remember, our trend is downward, and I would rather see that upward. But let's do the risk analysis, right? Let's say I risk this low here, this pivot low, or this floor trader pivot low, right? And I'm only risking maybe $1 or $2 as well, right? 310.17 versus 309.25. But where is that wood? Where is that resistance? Where is all that selling above my head, right? Am I going to get $3 or $4 worth of return on that trade? Yeah, it looks like I could do that, but which trade would you rather take? Would you rather risk $2 to make $20 or risk $1 to make $3? Well, I think all of us would agree we'd rather risk $2 to make $20, especially since our trend analysis is telling us that things look like they're going to go lower. Now, we might be wrong, but I'm willing to take that risk, okay? All right, so let's do this. So determining risk reward, we're going to set our stop in our trend time frame. That's where our trend is at risk. That's what we kind of just saw there with Microsoft. Our trend was in risk. Our market is gaining momentum. The market looks like it's going to go lower, right? But I could use that lower time frame to reduce that risk. Initially, we saw that that risk was too much. It was closer to like $5, but we used the lower time frame to lower that risk down to a couple of dollars. Now, one of the things you can do is when you're doing time frame analysis is you want to use a 4 factor or greater. In other words, as you move from one time frame to another, you want to make sure you're moving in a factor of 4 or greater. So for instance, like a monthly to a weekly, right? 4 weeks in a month, 4. Weekly to daily, 5 days in a week, that's a 5, right? If you're going in a stock market on a daily basis and you go from daily to, let's say, 1 hour, well, that'd be a 6, right? If you're trading futures markets or Forex, you know, they trade close to 24 hours, 23 hours. So maybe your intermediate, your higher time frame would be your daily, your intermediate would be 4 hours, right? That'd be a factor of 6. And then from 4 hours, you could go down to what? 1 hour, 3 minutes, or from 1 hour to 15 minutes, that would be a factor of 4. So for swing traders, here's kind of how you can do this risk management assessment. So we want to make sure we're realistic in setting our targets. Our targets need to be somewhere where we want to have a minimum reward of at least 3 to 1. I think that's a good rule for you. And if we think about this, this is an interesting statistics. If I only take trades where I set a risk of 1 unit versus a potential reward of 3 units, then I only need to be right about 40% of the time. Think about that. That's a huge statistic, right? I can be actually wrong more times than I'm right, as long as I'm taking those trades that have a greater probability and this greater risk reward ratio. Now, here's the conservative guideline. If I'm in a daily time frame, is my trend time frame, I'm going to set my targets at 1.5 to 2.5 times my ATR, and I'm going to try to set my risk at only a half of my ATR. So when we go back to that microsafe example, were we using half of our ATR for risk? Yeah, somewhat less is our target. We set a target, let's say, of $20. Well, maybe 2.5 times that it would be more realistic target. Now, it doesn't mean I have to take the trade off when we get there. It just means I'm using this as a risk assessment process. Okay. So let's do this. Here's John Murphy's Technical Analysis of Financial Markets book. This is kind of the encyclopedia of technical analysis. And I think this is kind of interesting. Notice that here's his 10 points in terms of a checklist. Points 1, 2, and 3 are this higher time frame analysis, right? The big picture, right? Weekly, monthly, the roadmap to price, right? What is the overall market doing, right? What's the big picture? And 4, 5, 6, right? And even 7 gaps can be used as levels of support and resistance. 4, 5, and 6 is all about trend, right? Where's our trend? What's our primary trend? What's our median trend? What's our lower trend? Where are these levels of support and resistance? Where are these swing highs and swing lows? What are those trend lines, moving averages, channels? Right? Where are we? Where is price in that range of probability? And then 8 and 9 are those pictures of price that we know, right? Chart patterns, right? Flags and dojis and candlestick price. And then that price objectives, right? Where is the target? Where is the path of least resistance? Where can price run to easily and not run into speed bumps? And notice at the bottom of our list here, is that technical analysis, right? That evidence that we're going to use to support our assessment. And this is where I think a lot of traders make a mistake. They start at the, the RSIs and the MACDs and the right. That's where they start their process, and not doing this top down, this multiple time frame analysis, and using technical analysis as that secondary or that enhancement to their analysis. So here's my takeaways. Know your playing field of probability, right? Where's that range of price? Where do I believe market can go? Identify my trends in all time frames. I'm going to be more concerned in my higher and intermediates. Determine the type of trade I'm going to take. Again, if I'm at one of these zones of action, right? What do I think is going to happen? What is my trend telling me? An example of Microsoft, the trends were all low. We're at a zone of action. I'm going to look for a breakout to the downside, right? If we were in an uptrend, if those higher time frames were in uptrends, then that zone of action would have been looking at a buying opportunity, looking to buy a dip or waiting for that lower time frame buy signal. Set my risk in my trend time frame, right? Where is my trend at risk? Where do I believe the trend is going to go from an uptrend to a downtrend? But then use lower time frames to help me to reduce that risk, right? Help me to find an entry and a risk that is less than. That's going to help me to get a greater risk reward ratio. Set some very realistic targets, right? We don't want to hit for the fences, although we will learn how to hold on to winning trades. We want to use a realistic target to help us to do that math, that risk reward assessment. And then notice at the bottom of my list here too, use technical analysis as a confluence of evidence. I'm not starting with technical analysis. I'm using it as that secondary or then enhancement. So here's the final takeaway. Relying on just one time frame or one technical analysis is a failure, is a recipe for failure. And technical analysis requires this perspective of over multiple time frames to help us to find these conferring and cross trends, right? If I'm getting multiple signals from different time frames, and then the market is telling me, hey, stay on the sidelines. Let's wait until they all start coming together. Now, various technical studies and tools can help us discover when these confluence or these clusters of evidence line up. Again, we want to look for those where they line up with our primary and our intermediate trends, right? And this is going to improve our confidence and that probability, right? That path of least resistance, that success that's going to allow us to maximize and manage our risk a little bit better. Okay, I went a little bit over today. I apologize for that. I hope you guys enjoyed that. Again, if you have any questions, send them to support at barchart.com. Just a reminder, there's a lot of things that I might be showing you today. Some of the tools that are available to you, especially creating all these multiple templates. These are all features that are afforded to Plus and Premier members. That you can have a 30-day trial. You can go in there and try out some of this that process for us. Next week, we have a special webinar. We're going to interview a special guest, and that is, familiar with is Darren Newsom. Darren Newsom is our senior market analyst. He has an extensive career. He's been in the business probably as long as I have. He has a little bit of an interesting perspective of how to look at trading. So I think what we're going to do is Darren and I are going to look at markets. We're going to talk about how we decipher markets, how we look at our strategies and the psychological aspects of trading. And we're going to kind of blend our two styles together to give you an insight in terms of maybe help you define your trade plan or help you define your psychology of how you look at markets. So I think this is really going to be an interesting webinar. So come back next week and look at that. Thomas, thanks for stepping in today. I appreciate your help.
You got it, John. I just want to say a couple things, John. We got a lot of questions about how to draw dashed lines or how to find specific studies. Guys, just go ahead and email support@barchart.com and we'll get you an answer most likely today. The webinars are recorded, so those will be up on our YouTube channel and the website later this afternoon. And then also, John, we got a lot of questions from people who just signed up for a Plus or Premier account. And you guys, we have a show. It's called Market on Close. It takes place on Fridays at 2:30 p.m. Central Standard Time. It's kind of a more intimate show. You can come, you can ask John your questions, and we'll promise you, John most likely will give you a detailed answer on those. So if you want to ask about technical confluence or anything really, just come and check that show out. We took last week off. John was on vacation, but we are back this Friday. So come and say hi to us.
Yeah, we have a little bit more fun, right? It's a little bit more relaxed. And actually, as you watch these shows, you can kind of start picking up on my style, and a lot of the things that I just went through today, you'll see as we look at markets, being played out over and over again, right? So I think they're a great learning opportunity as well, too, Thomas, right?
Yeah, absolutely, and it covers such a wide variety of topics, John. And we try to give everybody a little something. So I think people like it.
All right, Thomas. Thanks so much for stepping in. Folks, be safe out there. The best of health. And until next time, the good of all trading.